There's a lot to report this week, including the possible direction of the Federal Reserve, weakness in the labor market, potential trouble in the manufacturing sector, and consumer confidence pointing toward recession. Let's get into it. Before we begin, remember to like this video and subscribe for more economic updates. On Wednesday, Federal Reserve officials concluded their two-day policy meeting by leaving interest rates where they've been since last July. As with many other recent policy meetings, Fed watchers were focused on Fed Chair Jerome Powell's post-meeting press conference, from which they'd hoped to gain some insight about what might happen with interest rates in the near term. While the chair did not stop short of declaring that a September rate cut is forthcoming, Powell sent one of the strongest signs so far of a possible rate reduction next month. A reduction in our policy rate could be on the table as soon as the next meeting in September. According to the CME Group's FedWatch tool, which assesses probabilities of changes to the benchmark federal funds rate, traders now say there's a 100% chance of a rate cut in September. Turning our attention to the jobs market, a heavy dose of fuel was added to the rate cut fire on Friday when the Labor Department revealed that job growth slowed significantly in July. According to the numbers, non-farm payrolls increased by just 114,000 for the month. That's down sharply from both the 177,500 jobs projected by economists and the downwardly revised 179,000 jobs added in June. As for the official unemployment rate, that rose from 4.1% to 4.3%, its highest level since October 2021. The Labor Department checked in on Tuesday with the June edition of the Job Openings and Labor Turnover Survey, also known as the JOLTS report. The report reflected a modest decline in job openings to 8.18 million in June from an upwardly revised 8.23 million in May. Although the drop is seen as more evidence of slack building in the labor market, analysts remain unconcerned that it's a sign a more serious problem is unfolding. Still, Evercore ISI economist Marco Casaraghi suggests the pace of the loosening in the jobs market is consistent with the expectation of a rate cut in September. And in the wake of the Friday non-farm payrolls report, a growing number of traders now think we may see a 50 basis point rate cut next month. Also this week, the Institute for Supply Management checked in with worse than expected news about the condition of the manufacturing sector. On Thursday, ISM reported that its Manufacturing Purchasing Managers Index declined to 46.8 in July, below the forecast of 48.5. It's the fourth straight month the metric has come in under 50 and in contraction territory. More broadly, the index has contracted in 20 of the previous 21 months and now sits at its lowest level since last November. The key component measures of the overall index displayed signs of increasing distress last month. The new orders index, production index, and employment index each fell deeper into contraction territory, while the backlog of orders index remained well in contraction at a measure of just 41.7. The Conference Board reported earlier this week that its Consumer Confidence Index came in at 100.3 in July, up from June's downwardly revised 97.8, and about a point higher than economists had projected. The Expectations Index, a sub-index that gauges consumers' outlook for the economy 6 months from now, also increased this month to 78.2 from 72.8 in June. Notwithstanding the improved performance, it's the sixth straight month the Expectations Index has landed below 80 and in recession territory, This despite the fact that the Conference Board abandoned its official recession forecast in February. That's it for now, and a lot to digest. Make sure to join us again on Monday when we get back to what's happening in the economy. This is Devlin Steele for Augusta Precious Metals, signing out.